Thanks for listening to the ArtTactic Podcast. I'm your host, Adam Green. We're at an interesting point in the art market. With the recent wrap-up of European fairs and auctions, we now have a bit of a breather as we look ahead to November. It's a month packed with major gallery openings from around the world, key auctions in New York, and of course, Art Basel Miami to close things out. So in this week's episode of the podcast, we thought it would be interesting to take a deeper dive into the auction results from earlier this year to see where the market stands. So we're joined by Michael Moses, co-founder of Art Market Consultancy, and perhaps best known as being one of the co-founders of the May Moses Index, which was later acquired by Sotheby's. Hope you enjoy the conversation. Thanks so much for listening. Michael, it's great having you back on the podcast. How have you been?
I've been fine, Adam. It's been a while since we've talked.
It definitely has. You were one of our first guests on the podcast, and it's always great having you back on. So you've been compiling repeat sales auction data for years, and recently you shared some findings from the first half of this year. What are some of the key insights that you've uncovered?
Our results in the first half were a little bit of a surprise. The art market has been sort of trending flat as far as return goes for the last 3-4 years. But when we looked at the spring auction season, we had about close to 2,000 repeat sale pairs, and we found that the mean return of those 2,000 pairs was about zero. And that was the lowest it had been in this century. We basically study only a little bit like the S&P, big companies. Well, we study, in quotes, big artists, so that we are looking at artists who have at least 10, sometimes 25 repeat sale pairs. And it turned out that if you look at the trend of those returns in each half-year period, it turned out that this last spring was as bad as it gets.
Yeah, that's pretty unbelievable. And so while I know you're focused on analyzing the raw data, what do you think are the main factors driving the recent decline in auction prices?
Right. We were wondering what was causing it. And so the first sort of idea was, could the pre-sale estimates not be proper? The auction houses give pre-sale estimates. So one of the things we wanted to see was whether or not the estimates were reasonable. We have a purchase price. We can inflate the purchase price from the purchase date to the proposed sale date by the artist's mean return, and then see the difference between the low estimate and the mark-to-market price. And it turned out that return had been decreasing, so that whatever level of mispricing might have existed at the beginning of the century basically has trended down to zero. So if someone asked me, are the auction houses doing a bad job? My answer is no. They are giving a low estimate that is really very much based on what the returns of the artist has achieved over the years. So it couldn't be that mispricing was an issue. So the next thing we wanted to look at, which is also looked at in the art market, is the sell-through rate. And when we graphed the sell-through rate, that is the percent of works that sold, it was also the lowest. And so then the question became, why is the sell-through rate so low? And what we looked at is one of the reasons could have been mispricing, but that wasn't the case. So another was maybe too much is being put on the market. And that turned out to be true. In the beginning of the century, you would get in a half year you might get 500 works. Now we're getting 2,000 works. Remember, these are not total works. These are only works that had a prior successful auction. And so when you see a quadrupling in the quantity, that, definitely, as basic economics tells us, when you sort of increase quantity, you have to reduce price to clear the market. And so that seemed to be working in that direction. And then the second thing is what was the average price of the works? And the average price of the works in the beginning of the century was, in the 20th century, was about 200,000, and now it's up to about 600,000. So we've had a rapid increase in price and an increase in quantity. But when you look at individuals, that's way higher than inflation, and it's way higher than wage growth, earnings growth. So we have, this market where you've got almost too much on the market at too high a price. It just sort of drove the market down.
Well, that's really fascinating. And you mentioned the high supply at auction. I've had several conversations with collectors really over the last few years about the fact that you go to some of these auction house websites and it's nearly impossible to monitor and keep track of all of the auctions. It's kind of like a full-time job if you wanted to do it. It used to be very manageable, but now each auction house has so many sales. There's one in New York, and the following week in London, and then Hong Kong, and other locations. And you also have so many e-commerce sales. These online-only sales, I think they've actually made it much easier from a logistics perspective and much less costly to host auctions. So they've just increased the number of them. And it does feel like auction houses have created this platform with so many selling opportunities, and maybe to a degree this has produced this increase of supply on the market. Historically, from your experience observing the market, what generally drives supply at auction, and how much of this is collectors wanting to sell versus auction houses now all of a sudden having more bandwidth for collectors to be able to sell?
Right. I don't really have a good feel for that, except that, for a while when the market was doing okay, they kept saying, well, we need to earn money, therefore we need to have more sales. And because they make their money as a percent of sales. And so therefore, if the auction houses tended to increase their staffs and their locations, they tried to get more into the market. I think the problem with that is really in the 20th century that demand has been global for this entire time. It's not like in 1900 where things were really local. Demand for art is certainly global. All right, but it's been global for a long time. So, you may get a little bit ahead of yourself, and that's what happened. And it's also the point where the other assets have been doing so well. It's just sort of a combination brought together a lot of negative things that tended to hurt the market.
You mentioned other alternative assets. Have you tracked the correlation between different asset classes with art?
That's one of art's benefits. Even though returns haven't been great, it continues to be an uncorrelated asset. Its correlation is down to like 0.2. Historically, it had been even lower. At times, it had been negative, but it has very low correlation with almost all other assets. And that is, again, one of its benefits when we think of optimizing, modern portfolio management, about optimizing portfolios. Assets that are low correlated tend to play, even if their returns are not as high as possible. When faced with other assets that are doing so well, you might hesitate to invest in something that, while you may love it, its returns sort of dwarfed in comparison to the alternatives, who seems to allocate a certain percentage of their wealth to collecting. Part of, you can't get away from the joy utility of art. That is, it's not only beautiful for some people to look at, but it's also fun to be part of the market. It's fun to meet if you're dealing with a living artist, okay? It's fun to meet other collectors. So there is that joy utility part of art that investing in gold or the S&P 500 really doesn't bring.
And so while reviewing the data, did you discover any other interesting trends or elements of the market that you found interesting?
There are some fun things. Normally the market is described on single variable issues, one being return, another being sell-through rate. But there are other kinds of ideas that are talked about in the market. And so one thing we decided to look at was, let's look at lots of what we call hedonic variables, describe the work. That is, how big is it? Is it signed? Is it dated? And it turns out that each of these single item issues has ramifications. One I found interesting was the idea of a signed work. Do works that are signed have higher returns than works that are unsigned? And it turns out to be true that signed works have a higher return than unsigned works, about 40% higher on average. We collect all this data, so we have this storehouse of information. Not only do we collect returns, but we also collect all this other information, like size, number of previous owners, exhibitions, things like that. So the question then becomes, why does having a signed work make a return higher? Well, maybe because it's signed, it means it's less likely to be a forgery, because I think, forgers tend to not want to sign something because I think maybe make it, worse, that not only you faking the picture, but you're also faking the signature. But I'm not a lawyer, so I don't really know. But the interesting thing is that when it was purchased, it was also signed. So these aren't works that the signature has been added to. They were signed in 1970 and they were signed in 2010, same signature. So why are these works appreciating more than unsigned works? And my feeling here, we have to think about what's the difference in the art market from the start of the century and even before and now. In the year 2000, it's most likely the market was done by professionals than by individuals. All right. So there were more knowledgeable people in the market. There weren't as many, a knowledgeable person doesn't really need a signature to decide whether or not the work was original. But as the market shifted to becoming more non-professional, just folks like you and me in the market, we wanted some extra assurance that this work might be real, and maybe we were willing to pay up for a signature. While back in 2000, people didn't need to pay up for a signature because the professionals knew whether or not the work was real or not. So that's just one possibility. Now, you can look at the same information about whether it was dated, and that didn't seem to make as much of a difference. Overachievement by signed works, by dated works than undated works. And that includes works that were dated, have circa associated with them in the catalog. Okay? And again, I think it might be the same reason that, everybody feels that works from an artist's important period might perform better than a non-important period. And having a date for the non-professional allowed them to decide whether this was an important period or not. But for a professional, it didn't. They didn't need that information. So anyway, the art market is fun, and there are, we've looked at maybe 20 or so what we call hedonic variables to see how they perform.
So looking ahead to the major auctions in New York next month, I know predicting the art market or any market is challenging and often impossible, but do you have any insights into how you think the market might perform as we move forward?
We have not found a way of predicting. It's quite difficult. The only thing I would say is historically, the art market has shown mean reversion. That is, when you get overperformance, it eventually comes back down to average performance. So this might be a period of below average performance, so that if the mean reversion idea is true, that over time, purchases in this period may prove to be above average because you're buying sort of at a low point. The question is, you don't want to, in finance terms, don't want to try and catch the falling knife. But mean reversion is something that other researchers and we have found to be the case in the art market. So this might not be a bad time to start to look maybe a little bit more intensely.
Yeah, that's a really interesting point that you raised. I do think in times when there's talk of a market slowdown and buyers are becoming more selective, it can be challenging to make significant acquisitions. You really need strong conviction to buy in this kind of climate. But anecdotally, at least, I think some of the best acquisitions can actually happen in this type of climate. So I would say to collectors, definitely continue to monitor the markets. And if you see high quality examples by artists you really believe in, definitely do go for it. Michael, thanks so much again for coming on the podcast and sharing some of your key insights and perspective from all the data you're gathering and reviewing as part of Art Market Consultancy. We really appreciate your time.
All right. Bye.